Welcome everyone. Today we're diving into the world of fix and flip hard money loans. A real hot topic for property investors looking for quick
Yep.
profits.
Absolutely. It's fascinating how investors use these loans to purchase, renovate, and then sell properties, right?
Exactly. So, the core idea is you secure a short-term loan, which covers both the purchase and, the rehab costs of a property. It's all about flipping for profit in a matter of months.
And they typically give you something like 6 to 9 months, sometimes even extending up to 36 months if the rehab work is major. Isn't that right?
Yep, that's right. What I find interesting is that these loans, unlike conventional ones, aren't really based on your personal financial history or credit score.
Right.
Instead, they look at your equity in other properties.
So even if you have a less than perfect credit situation, you can still jump into the flipping game if you've got that equity backing you up.
Exactly, man. And it's really cool because these hard money loans are designed to be, fast. Approvals can come in just a few days, giving you the speed you need to beat out, say, all cash buyers in a competitive market.
Yeah, that speed is a game changer. Speed really makes a difference. I mean, imagine having a deal that could close in 48 hours. Who wouldn't want that edge?
For sure. And speaking of deals, there's this neat concept called the 70% rule. Basically, to figure out what you should pay for a property, you take the after repair value, or ARV, multiply it by 70%, and then subtract your repair costs.
Right? It's like a built-in guideline to help investors ensure they don't overpay, ensuring a healthy profit margin once the flip is complete.
Exactly, like if the ARV is $200,000 and your repairs are $20,000, you'd ideally pay around $120,000.
Yep, that's a clear, simple math. But what about the properties themselves? How does an investor decide what property is right for a flip?
Great. So for residential flips, you want neighborhoods with strong market outlooks, signs of rising prices, and areas where there's like a steady influx of buyers. It's about spotting motivated sellers, owners of distressed homes, foreclosures, or even short sales.
And it sounds like you should avoid properties with major structural issues, right? It's more about cosmetic upgrades that really add value without overspending on deep fixes.
Exactly. New appliances, countertops, and flooring, those sort of updates, are often enough. I mean, it's like, when you're cooking, you don't need a brand new stove. You just need it to be working well enough to deliver a tasty meal.
Haha, that's a pretty solid analogy. I love that. And shifting gears a bit, what about commercial flips? They seem a bit more complex.
Right. Commercial flips do come with their own flavor. For instance, apartment complexes or retail properties in emerging areas are prime targets.
Yeah, and location plays a huge role. So aside from, the basic idea of buying low and selling high, for commercial properties, you've got to factor in things like ample parking, access to major roads, and maybe even mass transit options.
Exactly. And there's a twist. The financing for commercial flips, often called bridge loans, usually has longer terms than residential ones, which is necessary given that commercial renovations can take a bit longer.
But wouldn't that also mean that the returns might take longer to realize?
Yeah, typically the sales cycle is longer, so you need to be comfortable with that. But the underlying principles remain. Minimize your rehab costs and maximize the value. It's a balancing act, really.
Now, while these loans are appealing, they're definitely not without their cons, right?
Absolutely. And that's where the risk assessment comes in. On the plus side, you get quick closings and high potential ROI with no prepayment penalties. But they come with higher interest rates compared to traditional financing. And of course, the funds are strictly for property purchase and renovation.
Right, meaning if your rehab draws are delayed or if you have unexpected cost overruns, you could get stuck financially.
Exactly. It's a double-edged sword. Some of the challenges include things like unexpected repair costs, delays, and even the risk of a lower sale price.
Yeah, that's a fair point. And I imagine that's where asking the right questions up front becomes critical, right?
Spot on. There are 13 key questions you really should ask before locking in a fix and flip loan. For instance, you need to know the points and interest rates, which can really affect your bottom line.
And terms are just as important because they determine how long you have to complete your flip and what kind of monthly payments you'll be facing.
Yup. And then there's whether the loan is based on the ARV or the current value. Since fix and flip loans are usually based on ARV, you'll potentially get more cash for the rehab, but you'll also be looking at a requirement for a down payment, usually between 10–25%.
Right, that detail can easily be overlooked. Also, asking about appraisal requirements is crucial. If the appraisal is off, you might find yourself in a situation where the deal just isn't viable.
Exactly. And then you have to consider upfront fees, penalty fees, and the method of dispersing rehab funds. These draws necessitate that you have some cash on hand to kick things off before the lender releases more funds as work gets done.
Right. What about, say, if things don't go as planned? Is there a fallback option?
Great question. Some investors follow the Beer RRR model, the whole buy, rehab, rent, refinance, and repeat thing. That way, if the market shifts or if the flipping timeline drags, you can, convert the property into a long-term rental.
That's a smart strategy.
It's kind of like having a backup plan built right in.
I get that. But, don't you think that sometimes the risks may outweigh the benefits? How do you, really justify taking on this kind of financial risk?
That's a valid challenge. While fix and flip loans offer a high ROI and fast turnover, they do involve a lot of variables. It's essential to have a deep understanding of market trends, repair cost estimations, and a buffer for unexpected issues. You really need to be meticulous when planning your flip.
Yep, attention to detail is absolutely key. So essentially, it boils down to having a solid strategy backed by expert knowledge, knowing when to invest in a fix and flip, having enough collateral, and the ability to handle project surprises.
Exactly. And that's also why lenders like Secatra Capital have streamlined processes with quick pre-approvals, speedy appraisals, and reliable updates, which in turn help mitigate some of that risk.
Right, having a partner who understands these nuances is a major plus. And I guess at the end of the day, if you're thoroughly prepared and have lined up the right questions to ask, these loans can very much be a winning tool for investors who are willing to put the work in.
Exactly. It's a high-stakes game, but the potential rewards are substantial. It's like a fast track to significant profits, provided you manage the challenges smartly.
Yeah, managing risks is what sets apart the pros from the amateurs. Absolutely. And on that note, for anyone looking to dive into the fix and flip world, understanding every aspect, from the calculations with the 70% rule to the detailed questions you'll ask your lender, is crucial to success.
Yup, totally agree. So, whether it's residential or commercial, if you're eyeing that quick turnaround for profit, make sure you do your homework. Remember, speed, strategy, and sharp insight are your best assets in the fix and flip.
Indeed. Well, that's been an energizing discussion, a blend of art and math. Thanks for breaking that down so clearly.
My pleasure. And for those tuning in, take this as your roadmap to navigate fix and flip hard money loans, so you can flip smart and, hopefully, flip profitable.
Absolutely. Cheers to smart investing.